everyone. In this video, we're going to take a look at the Chapter 13 practice with feedback exercise, homework exercise. In Chapter 13, we just have the practice with feedback portion. There is not a separate Excel-based homework necessarily. And I'll also say that in Chapter 13 for the practice with feedback here that we'll look through, there's quite a bit of just drop downs and matching terms and definitions, vocabulary, things of that nature. So I'll take a look at those briefly with you all, but they're something that you all can solve on your own. So I'm going to leave most of that to you. And I'm going to focus in mostly on some of the ratios and Excel type of calculations within the practice with feedback homework assignment here, because there's some linking and it's actually a chance to practice some Excel skills while we learn and solve the homework problem. So, okay, so just to begin, as I mentioned, there's a lot of drop downs, matching, that kind of thing. So just refer to your support as far as the book, the lectures, your notes, etc. And you can just do a drop down for these, and you'll just go through, matching. And you'll have a number of options to select from. Here you're going to analyze whether investors prefer high or low for each of these ratios. For example, profit margin, you want a higher profit margin, but investors generally would rather see a lower debt ratio. So some metrics are preferred to be high, some are preferred to be low. So that's what you're going to accomplish there. Then you're going to look through and just kind of match some of the ratio types to their definitions here. So again, that's another just vocabulary matching terms type of exercise. And then similar down here in exercise 4, you've got actual specific ratios, and again, you're going to compare those to ratio types and input those as you go. So all pretty straightforward. I think, like I mentioned, you'll just have to refer to your notes, read from the book, watch the lecture videos, so on and so forth to answer those parts of the exercise. Similarly, in exercise 5 on the next tab, you're going to go through and analyze ratios here. So we have your company, their company, and then industry average. And so you're going to go through and analyze each one of these from that perspective of a comparison. For example, A asks, is your company's asset turnover better or worse than the industry average? So if we look at industry average, we look at asset turnover ratio. We've got 6 or asset turnover calculated for the industry average, and this is a 4 for your company. And asset turnover, generally we want that to be high, and so it's lower than the industry average. So we're going to say worse for that one. And so again, you'll have drop downs to select on each of those, and you just do a benchmark comparison for those ones. So I will leave that up to you all to complete. Okay, then we're going to move on to some of the actual calculations here on the third tab over, starting with exercise number 6. And in exercise number 6, we're going to be analyzing and calculating various ratios and also just specific items here using the data above. And one thing I want to highlight, in these practice with feedback forms, I can't click specifically into the cells here like you can with a normal Excel worksheet. But one thing that you can do is you can still do a formula, and you can reference to these cells, which is handy. So I'll kind of show you that now. So keep an eye up here. This is our formula bar. And so to calculate gross profit, we're just going to take net sales minus cost of goods sold. So net sales is E6 if we want 2023, and then cost of goods sold would be E7. So we can say, and I'm just going to put it in parentheses because we're going to use it in some of our calculations later. So E6 minus E7, hit enter, And so you'll see it does refer back to the cells. And once you have this reference, you can actually move them around. So that actually is a way to adjust your formula. You just can't specifically click in because all these cells are protected. That's how the whole spreadsheet works to get with the X's, etc. So, but once you have this calculated, one handy thing here, and this is one of the things I wanted to highlight, is that you can then, do your cursor over the bottom right. You see where it turns into kind of that black cross. You want to have it be that, and then click your left mouse pad, and then you can drag it this way. And so you're just going to drag that formula over, and you can see how as you drag it over, it updates into the next column and calculates out. And so that just immediately gets rid of the X's there without having to redo the formula. So that's a nice way to do it. So then for net income, we're going to want gross profit. And then we're also going to want to subtract out other expenses. So we already subtracted cost of goods sold. Now we're going to subtract the rest of the expenses to get us to net income. So our other expenses are E8, it looks like, for 2023. So we can just put that in, E8. Yep. And then again, we can just drag across, and that'll just pick up the other expenses, and it's using the gross profit above minus the other expenses. Okay, average inventory now. When we're doing averages for inventory or total assets in this class, typically we always just do 1 year, last year plus this year divided by 2. There's just two things there. And so for this one, we're going to 2024, we want to go into inventory for 2023. So again, we'll do our formula here. Let me find which one. Okay, so E9 for 2023 plus D9, that's going to be inventory for 2024. Then put parentheses around that to do that calculation first. And then, like I mentioned, just divide by 2. And be careful here with the parentheses. I think if you leave the parentheses off, it will, the math, which will follow the order of operations, will do division first. And so it will take D9 divided by 2 plus E9. And you don't want that. You want E9 plus D9 divided. You want the whole thing divided by 2. So that's where the parentheses come into play to ensure that this is the first thing that we do from the order of operations. Okay, again, we can just drag that over. Very easy. And then this one, average total assets, let's just drag this down because that formula is very similar. And then it's kind of easy. So here, once we drag that average inventory formula down into the average total assets, you can see it's picking up average current assets right now, but we can just easily go up and then drag that to our total assets line, hit enter, and then we can just drag that across to get rid of the X's there. Okay, great. So now let's do our gross margin ratio. So we have gross profit, up here calculated. So to get gross margin ratio, we just want to take gross profit divided by net sales. So again, we can just link up to gross profit, divide by E6, net sales. That gets the X to go away there. And then we can just drag that across. I'm going to drag this down just because I find it easy to do that and then just modify, the reference, the cell reference. So here we want the profit margin ratio. So gross margin ratio is gross profit divided by sales. The profit margin ratio is net income divided by sales. And so we've got net income here, so that's working. And then we just need to fix that back up to be sales. So that is the divisor denominator, and then drag across, and you're good to go. All right, return on assets is our net income divided by our average total assets. So we can link those pretty easily. We can click into these cells so that doing that type of formula is quite easy. We've got our current ratio. So the current ratio here is going to be current assets. So that's going to be E10 and divided by current liabilities. So E12. Okay, we got 1.75. Drag that across. You can see our current ratio is decreasing, so that's actually kind of a a concerning thing if you were an investor, for example, or management looking at these ratios saying, possibly concerning. We're saying, okay, we have less assets to pay off our current liabilities. So just something to keep an eye on. And then inventory turnover, we're going to do something very similar above. We're going to take cost of goods sold divided by average inventory. So let's go. Cost of goods sold is D7. So there we go. Pick that up. And then we're going to divide that by average inventory, 15, and then 10. So basically what we're saying with this ratio is how many times did our whole inventory turnover? How many times did we go from the average inventory amount we had to 0 and then back again? And if you're a business who makes money by how much inventory they sell, you would like to have a higher inventory turnover. So again, another slightly concerning metric, I suppose, if you were analyzing this, which it doesn't ask us to do specifically in this problem, but I just want to highlight those things as we're working through so that you can actually comprehend some of the purpose of what we're doing here in addition to the mechanics of it. Okay, asset turnover is us taking, it's kind of maybe I'll just drag this down because it is somewhat a similar calculation. So in this instance, though, we're going to take our net sales divided by average total assets. So again, dragging it down from here just kind of primes your formula. It's easier, in my opinion, to just drag around to recreate the formula instead of typing in the cell references again. And then finally, we have the debt ratio, which is just our total liabilities. So it's that E13 divided by total assets, E11. So here we're saying what proportion, as a proportion of our assets, how much does liabilities take up? And so you can see that increasing. So yeah, so that's the mechanics there. We can just drag that across, get the X's to go away, and we're good to go. All right, so let's go over to the next tab, exercise 7. Again, this is just basically kind of a drop-down one. It's very similar to what we were doing on the earlier tabs. What does each ratio determine? Asset turnover. Again, it's this idea of specific types of ratios, with assets turnover being an efficiency type of ratio, valuation for dividend yield, acid test, which is the current ratio but just a little more strict, is how many current assets, quick assets, if you will, to pay off our current liabilities. So that's a liquidity type of metric. So similar to what you will have done at the first few tabs there. I'll let you all work through the rest of those on your own. And then on to exercise number 8. We're going to do a little bit more calculation here. These ones are pretty easy. You'll see here quickly, they're kind of set up in a way that actually makes them quite fast once you understand, putting the formulas in and all that. Okay, so when we're doing horizontal analysis here, we're using, 20x1 as the base year, so this one here. And so when we're talking about a base year, that's going to be 100%. So we're dividing it by itself essentially, and then we're going to divide each subsequent year by that amount. So it's not going to be 100%. We're going to see what kind of differences are occurring as the years proceed. So for net sales, then we're going to want to just do E6 divided by E6, kind of a goofy formula, but that gets us the 100%. But what I wanted to show you all here that's kind of important is, just as I mentioned, what we're going to be doing is dividing each additional year, subsequent year, this, for example, divided by 1320, and then this 1620 divided by 1320. So E6 is going to continue to be our denominator in this, and it will also be our denominator kind of as we go down, whatever's in this column. So one little trick here I wanted to show you is that you can come into the denominators and you can put in dollar signs around just like that, like $E, $6. And what happens when you do that is when you drag your formula across now, it's going to kind of stick the denominator. The denominator will be sticky. It's going to stay the same, in other words, as you drag it across. Alternatively, if you didn't have that dollar sign in there, for example, just like this, as you drag this formula across, then it would just be saying C6 divided by C6, D6 divided by, so it's basically just moving both the denominator and numerator horizontally, but that's not what we want. We want the dollar signs so that when we drag this across, it continues to reference E6 as the denominator. So just a little handy trick for you. And then let's just drag these down. The one thing you got to be careful with, though, when you use that is it will be sticky everywhere, and that's not always what we want. So here in this instance, for example, we have to move that reference down to be the correct, other expenses is going to be E8. But once we have that, again, we can just drag these across, and those will disappear promptly. Okay, vertical analysis now is where we're going to do analytics just within a given year, essentially. And we're going to use total assets as the base. So again, similar to what we were looking at with horizontal, we're going to take C13, so total assets divided by total assets. Again, kind of a funny formula, but let's go ahead and put our dollar signs into our denominator. And one way you can do this, what I'm doing to do this, you can type dollar signs around this, but you can also just click into this cell reference anywhere and then click F4 and it will add those dollar signs there. So that's kind of a handy way to do that. And then we can just drag this across. Again, we need to fix the denominators because we do have the dollar signs making it a little sticky there. But once we have that accurate, now we can just drag this up. And what you'll see is because prepaid, insurance, inventory, these line items agree to what's exactly above, it's really easy for this problem. You just drag this up and it automatically will divide the next line item above by total assets there. And because we put in the dollar signs, it will just hold on to that total assets amount as the denominator as you drag upwards. So kind of just some Excel skills to practice with in this one. I thought that was useful to kind of show. And excuse me, what does this tell us? Just let's take a moment just to review the results here and see if we can make any inferences about what's happening. So we've got net sale, increasing net sales is good. We've got cost of goods sold increasing, which is what we would expect for a business that sells inventory. If you have net sales going up, you should expect to see cost of goods sold going up as well, most likely. Other expenses increasing, which is pretty reasonable as business grows. You could also do the vertical analysis here is going to show us, one second here, just get a phone call. Okay, so sorry about that. If we look at the vertical analysis, then we can show, we can see, let's look at cash, for instance. So our cash balance as a proportion of total assets has increased. So we have a higher amount of cash overall as a proportion there. Generally, it went up, then it went down a little bit. That may or may not be good. We kind of need to know the business's goals. Maybe we don't want to hold too much cash. We want to invest that money instead or something. So, or buy more inventory or something like that. AR is dipped. Now it's kind of 35%. So if you had growth of sales and you're maintaining AR, that might be decent. Again, you might want to compare this to industry averages to really understand whether these are good numbers or not. But internally, we're maintaining our AR balance as a percent of assets, even with increased sales growth. So that would generally indicate to me that we're doing a good job of collections, unless back in this day we were not doing a good job of collections and we're continuing to be high, maybe. So it's a little nuanced. You need to understand the industry, you understand internal goals, so on and so forth. So that's what this kind of allows us to do. It's a starting point for us to analyze the business and then potentially, evaluate the business and maybe make some changes possibly. Maybe you say, oh, this is actually really high compared to the industry standard. Maybe that means that we need to hire some additional people to work in our AR collections department or something like that. Or maybe we need to do something different there. Send out notices to our customers, offer discounts for being paid sooner, things of that nature. So it just gives us information here that we can make inferences about business operations based on the numbers that we've been working so far in the course. Now the first portion of the course is how did we get these numbers, where they come from, debits and credits, understanding accounting transactions and the resulting financial statements and so on and so forth. And then here in chapter 13, as we jump forward a bit in the book, but it's a good time to look at this because this is really like, what do we do as managers or even investors, anyone that's using the financial statements, how do we use those? And using ratios and metrics like this is a good way to do that. Okay, so let's just look at exercise 9 real quick. This one again is just another matching drop down type of exercise, so I'm not going to spend too much time on this. I'll leave it up to you to review your supporting materials to be able to answer these questions. But basically this covers a wide variety of things related to financial statements and annual reports, etc. And so you'll see, also known as a statement of owner's equity, statement of shareholders' equity, and another name for that would be retained earnings statement, for example. Potential liabilities, kind of the technical term for those things you'll see in an annual report or financial statement would be contingent liabilities. Where's the inventory method usually disclosed? That would be in the notes. And here it's got an answer for summary of significant accounting policies for inventory. This one talks about summary of significant accounting policies for property, plant, and equipment. So that's where we would talk about our depreciation method. And I'll let you all, like I said, finish these out. But that's the goal, is just to use your supporting materials, notes, lecture, book, so on and so forth, to be able to match these and answer these questions here. So, all right, well, hopefully that was helpful, and hopefully you picked up maybe a little bit on the Excel front there. And as always, let me know if you have any questions.